Good morning, everyone. After listening to the morning panel, which I thought was a wonderful colloquy on some of the issues in the financial services sector, I actually put aside my remarks because I wanted to respond to some of the issues raised, such as regarding a consumer financial protection agency, how we got into this mess, potentially some of the solutions to the crisis, but also to talk about where we are right now and how do we move ahead in a way that's constructive. The National Community Reinvestment Coalition, close to a decade ago, testified before Senator Sarbanes and the Senate Banking Committee at the nation's first hearing on the issue of predatory lending. I remember the hearing very, very distinctly because to my left and right were representatives from the nation's major trade associations serving the banking industry, the mortgage broker industry, appraisers, and others. And we all agreed, if in fact this nation, if our regulators, if we all as citizens and corporations would comply with existing statutory and regulatory authority, there would be no need for, in fact, a new national anti-predatory lending law. That was the beginning of our current crisis that we are facing today. The issues then were single premium credit life, no income verification loans, and a host of other issues. Was pricing fair based on risk? Was there discrimination in lending or not? But those issues of that day have now morphed into issues of regulatory failure, of economic malaise, and other issues that we must contend with today. Relative to the topic of this panel, quite candidly, there is no private sector mortgage industry at this time. If this year you applied for a mortgage, it was purchased and securitized by Fannie Mae, Freddie Mac, or FHA 90% of the time. The market is frozen because of the crisis that we are in. So how did we get to this point? What led to it? Earlier, we heard about some of the remarks that Chairman Greenspan made during his tenure. He spoke to greed and malfeasance in the system. Frankly, it was well known. NCRC has filed grievances, complaints to HUD against 3 of the major nation's rating agencies. They are not publishers. In fact, investors were relying on their ratings time and time again for the investments they were making. It was well known for up to 3 years that subprime paper was not worth the paper it was printed on, but they continued to give AAA ratings to those industries. With all due respect, though the SEC has been a leader in many issues, where was the SEC at that time? We are full of regulators. We have too many regulators. This week, Chairman Dodd has probably done the most significant thing that we have observed during the entire debate about financial reform. Whether you agree or disagree with his proposal, he is proposing very, very significant change. And the underlying issues are the issues that we as counsel, the lobbyists on the Hill, and everyone is watching. Assignee liability, preemption, holder in due course are all intertwined on these issues. Who will be regulated by whom and what authority will they have? Where will there be a transparency? Where will there be accountability? The fact of the matter, a pure vision to address consumer issues, to address risk in the marketplace, to look quite candidly at resolution authority, and all of the other proposals he is making are quite unique. The bill that came out of the House ultimately was watered down to such a point, you may be surprised, that we at the National Community Reinvestment Coalition view it as an enigma, similar to, in fact, some of the major business trade associations in the United States. There's no reason banks or community banks should be treated than financial service corporations, and we all should be working for safe and sound lending that is responsible at its core. My typical day at NCRC is on 2 fronts. I work to coordinate our fair lending and our consumer protection programs. We operate with 40 organizations around the nation, a rescue program, a foreclosure prevention program. Why is it that I see time and time again homeowners who were given option arm products and who are also then given a home equity line of credit to buy their home? Now let's break the myth that you heard earlier by one of the presenters in the first panel. This is not a crisis brought about by lending to African Americans or low to moderate income consumers. The Federal Reserve and others have documented in many reports that only 6% of the high-cost loans that were originated by banking institutions regulated by the Community Reinvestment Act. The truth of the matter is, if the Community Reinvestment Act is expanded, as under H.R. 1479, we would not be in the mess that we are in today, because safety and soundness, which is part of the two-page document of CRA, is required by every regulator who enforces that law. These are very difficult times right now. Clearly, Leitch, Bliley, and how it, frankly, deregulated Glass-Steagall played a very important role here. We need to take a fresh look at what's happening, frankly, on all issues. If we have an enforcement regulatory regime and a statutory regime that promotes responsible lending, it's win-win for communities, consumers, and, frankly, industry alike. We believe in that dialogue. We think it's constructive to the regulatory process that we are in right now. What's happening in the absence of that? We have a marketplace that's dominated by the government. How many billions is the Federal Reserve, over 400 billion, putting into liquidity to buy loans right now? What is happening right now relative to the marketplace as a whole? Look at the City of Baltimore litigation against Wells Fargo. That case is just the first of what will be, I believe, a series of tobacco-type litigations filed by municipalities who saw disparities, discrimination in lending that has now led to foreclosure, that ultimately is lowering the tax base and prompting a major increase in taxes nationwide. Next year, the major part of the bubble is going to hit. And again, it wasn't from subprime, it wasn't from low to moderate income consumers, and this is not my data or NCRC's or any other advocacy organization. It comes from Credit Suisse and a host of other government companies. The option arm bubble is about to hit. Between 2010 and 2011, white, middle-income, relatively affluent consumers around the nation are about to face foreclosure, because their $800 to $1,200 mortgage payments are about to adjust up to between $1,900 and $3,500 per month. We are not through this issue yet. And until the government begins to address issues that will, in fact, address the bad debt that, frankly, investors, banks, and others are holding, whether it's a good bank, bad bank solution, or another approach, using the marketplace to use reverse auctions to acquire loans at value and then modify them. There are many different models that are being discussed. Until the market begins to discuss that, combined with regulatory restructuring, our economy is going to continue to, in fact, struggle. On the commercial side, the retail side, many of the big box developments, many of the corporate developments that you see across the country were developed with similar, frankly, non-traditional products that are now defaulting on the residential side. Until we address this issue for actually the investor as well as the resident and small business holder, we are not going to get through the current economic crisis. Thank you.